We are back. Sam Seder, Emma Vigeland on the Majority Report. Joining us now, Benjamin Shestakofsky. He is an assistant professor of sociology at the University of Pennsylvania, author of Behind the Startup, How Venture Capital Shapes Work, Innovation, and Inequality. Benjamin, welcome to the program.
Thanks. Good to be here.
We just turn him up just a little bit. All right, great. Let's start with sort of like some broad strokes. One of the things that your book looks at, and it's a really interesting ethnography because you sort of walk the line in terms of like assessing it and being part of it, as it were. We'll get to that in a moment. But broadly speaking, talk about the change that venture capitalism and, you know, I guess more broadly, sort of like this shareholder value, you know, I don't want to call it a revolution, but massive change in our economy. Like, broadly speak about the implications of this and sort of like when this has come about.
Sure. So the rise of venture capital is often traced to sort of the late 70s, early 80s, when, as part of a broader set of changes that were kind of increasing the power of financiers over the economy, were also going on in ways that affected the VC market. So you had a ruling from the Department of Labor in 1979 that said to pension fund managers, now you can invest in riskier assets. So a lot of money from pension funds started flowing into VC. You also had sort of more incentives for folks to start putting their money into new companies this way because the capital gains tax was decreasing pretty substantially, which means that if you're an investor and you make a lot of money through financial investments, one of which is venture capital, you get to keep more of the money you made. So that's sort of when this all started vis-a-vis VC, but it's really part of a broader set, like you said, of changes that has empowered investors and empowered shareholders to have more of a say in how companies are run. And what that usually means is that they tend to make sure that the gains that are being generated by companies, that more of them are sort of being funneled up to the folks at the top, which often comes at the expense of workers and the folks at the bottom.
So, all right, so we got these three things, and I want to just make this clear for everybody because it's so fascinating how, those type of sort of what seemingly disparate policy changes in the 80s implicate so many other things, but they also go off in other directions too. So for instance, when the reason why they open up the opportunity for pension, for people who are responsible for pension funds to go after riskier investments is that way, if I'm a company and I'm funding the pension for my workers, I don't have to put as much money in. If I can reasonably say, well, we're putting we're investing over here, and if it works out, we're going to get 12% returns instead of 7% returns. So I only have to put in $5 instead of $8 into the fund. And of course, a lot of people end up losing their pensions because of this. And we end up having to bail them out with the Pension Guaranty Trust. It's usually not necessarily dollar for dollar. So a lot of people are robbed of their pensions, which again is a commitment that is made contractually. It's just basically deferred pay for people. And it ends up encouraging the rise of 401ks and getting rid of defined pension contributions, all of that. And then it impacts on the other side where it starts to have this dumb money out there that people can go, venture capitalists can go and basically go to the racetrack with, and they're playing with, somebody else's pension money at that point. The capital gains tax across the board has implicated not just it incentivizes investment income over work, over labor income, but it also changes what the idea is success means for the CEO, the board of directors, the entire C-suite. And that's when you talk about shareholders having more say. This is not a situation where shareholders go like, we need to be more socially conscious. And therefore, we have more of a say. It basically means like they want more returns. They want higher returns. And it means even in a short-term sense, like it doesn't matter where the company's going to be in 30 years, as long as like that value shows up now. And that's the game that we're playing here. So, okay, so let's back up and then go to like, how did you come to write about, well, it's not a fake company, but you gave it a fake name, All Done. How did that happen?
It started, I was a young grad student in the sociology department, and I got interested in this world just because I had sort of randomly gotten sucked into it myself before I became a sociologist. I had a friend who had started a company in New York back in the aughts, and he just came to me one day and he said, hey, I convinced this angel investor to give me, I don't know, like $500,000. I'm starting this thing. Will you come work for me? And I did. And, what became very clear was that he was a really good talker. He could talk anyone into giving him money or press coverage or things like that. But there's this huge gap between, all the promise in this in this tech world, in the VC-backed world, and what was actually being delivered. And so that's kind of what I wanted to investigate when I went to grad school, and I ended up getting into this startup where they were willing to have me around, and I basically started as an intern, doing a little bit of work for them, and it turned into a lot more work. Stuck around for about 19 months, and really got to see from the inside how this model of chasing venture capital investment structured everything that happened inside this company.
So we should say, like, you offered to intern for them in exchange for being able to sort of like observe and study them.
Yep.
And then at one point too, though, you took a break from ostensibly studying them, but you're still obviously studying them to work for them full time, right?
Yeah, I told them they offered for me to work full time if I were to kind of step away from being a full-time grad student. And I agreed to do that. We had the understanding that I would continue to gather data during that time. And so, so I spent a year working full-time, sort of ended up in middle management of this company, which is pretty rare for an ethnographer of work, but it happened.
I find that sort of hilarious, but it's also a great way to pay for a grad school, I guess, too.
Absolutely.
All right. So let's talk about, there's really three sort of like geographic locations, but there's also three very, very different dynamics that are going on there. Let's start with San Francisco, which is where the headquarters were. Like, what was, the thing that I find fascinating about this is that the nature of the investment and the nature and the structure of and who's investing and why ends up defining both the labor structures and what products essentially we end up seeing, because this is a story about, in this instance, it's about services, but it's also can be about medical innovation. It can also be about broadly technology, and so on. But let's start with San Francisco. Like, describe for us the dynamic there.
So, yeah, I think what's really important to remember is that if you are working in a VC tech company, a VC-backed firm, that your company it's an asset, right? It's an asset that's owned by people who have a specific investment strategy. And so they pour a ton of money into a bunch of different companies, a whole portfolio of companies, and they're expecting that maybe 1 in 10 is going to massively increase its value. And that's all it takes for them to make huge returns. So everyone who's inside these startups, especially sort of in the headquarters, like the one where I was situated, it's their job to just be constantly experimenting with their technology to see what can they do to push those numbers up. Because pushing the numbers up, whether it means like the number of users they have, the number of views they're getting, the amount of revenue they're taking in, obviously it depends on what their product is. But if they can show that they are kind of generating this massive hockey stick type growth, then that's what means that more capital is going to be flowing their way, because even more investors are going to want to get in, early enough that they can make a bunch of money on this fast growing company. And so everyone inside of the headquarters is sort of just really wrapped up in the excitement of constantly tweaking things, adjusting things, changing things, trying to figure out what can we do to this product to see if we can get our user numbers up. And when they manage to do that successfully, it's really exciting because these are folks who all hold stock options, right? So if the investors get really, really, really rich, they may get rich or, make a bunch of money. So even though, 9 out of 10 probably are not going to make it, there's sort of this fantasy that everyone's wrapped up in that, hey, this could be us, we could make it. And every little move they make that gets the numbers up is sort of a new source of excitement that kind of gets them pumped to keep moving and keep pushing forward.
Can you distinguish, though, just for those of us who haven't necessarily been in the business, or like, how is that different from like starting another company? Because in some ways, this is like, my job is to go out and buy as many lottery tickets as I can, and one's going to pop, as opposed to like, I can only buy so many lottery tickets that my revenue can sustain. In other words, like, they're not necessarily looking to create a profitable business. They're looking to create something that looks like it might be a profitable business, right? And can you just explain that difference?
Yeah, I mean, again, what's really crucial here is that the VC-backed startup is an asset that's owned by these investors who, again, have placed a bunch of bets, and they're hoping that, a small number of them will make it big. So you're in a situation where it's not, it's not like I got a bank loan and I'm using that to grow my company and I'm going to pay it back with interest. And I'm going to be just kind of going for the slow and incremental growth that's going to build a sustainable business that's going to allow me to pay back my bank loan with interest. The point is that there's some people kind of behind the curtain who gave you a bunch of money because they think that they can multiply that by 10, 20, 100, 1,000. And so, everything you're doing is not about creating a sustainable business. It's not about, that kind of incremental growth that a typical small business might be going for. It's about how can we pump the numbers up so that the next investor down the line wants to pay way more than the last investor. And all the people who were in at the beginning, regardless of whether this company is profitable, they are going to be able to cash out. And then eventually at the end, someone's going to be left holding the bag when there are no profits.
There's sort of something called it's a Ponzi scheme on some level, right? I mean, isn't it?
I mean, it depends. We never know really what the outcomes of some of these companies are going to be, right? Some of them do actually end up being immensely profitable.
Right.
But many of them, like if you track tech IPOs where, in a period where the last few years, the majority of IPOs are not for companies that are generating profits, operating revenues. But again, profits for the early investors just means that I sold my stake in the company for way more than I originally paid. So operating profit of the company, its ability to generate more revenue, more money in revenue than it spends, is just a totally different proposition from for the early investors, I put in this amount of money, then I sold my stake for way more because someone else down the line thought that, if I buy now, the value is going to keep going up and I'll be able to do the same thing. I'll be able to sell for way more than I originally bought.
So there's a lot of like these companies that fail, but the original investors, these VC guys, still walk away with a ton of cash that they made, despite the fact that they made a complete failure because it looked good enough at that time. So, it looked like it was, believe me, there's a ton of gold underneath this riverbed here. Okay, I'll pay you more for it than you paid me. I walk off and it turns out there's no gold there. Hey folks, don't forget to hit the subscribe button and check out our daily show. We do it every day at 12 p.m. Eastern for about 2.5 hours. We even take phone calls. You should check that out.